Hi, I'm Joe DeLisi, and this is the Joe DeLisi Financial Advisor Podcast. I don't feel old, but I guess at 51, having done this industry, been in this business for almost 30 years, I guess I'm the old guy or one of them. And I know that because when I'm at conferences and I'm doing speaking sessions, mostly the breakout sessions. If you've ever been to any kind of a conference, you've got the big hallways of auditoriums, and then you've got the kind of smaller rooms. And the smaller rooms are typically, let's say, 50 people, something like that, 20 to 50 people. And so it's more intimate. You can ask more questions. And I do a lot of speaking around investing and how we build portfolios and what we do and what we don't do for our clients and how that all works. And this is, again, to advisors, generally speaking. As time has gone on, I get more and more questions from younger advisors around a lot of different things. Like, how did you choose your staff? How did you choose to build your business this way? Why this? Why that? All these kinds of things that I asked when I was 23 and 30 years old. But I'm starting to get more and more questions and conversations around how did you come to this investment philosophy? And where that comes from is because actually, after I speak about how we invest our clients' money, advisors, their interest is piqued. And they'll ask questions like, where can I go read about this? What podcast can I listen to? And the last time that I was asked this question was actually yesterday, and I had no filter, and I'm like, man, I hate that question. I just hate it because there's no good answer. There's no good answer because there aren't that many people who actually do it this way. And that got me thinking, another topic I talked to advisors about is, well, where did this come from? Obviously, I didn't invent the way that we invest our clients' money. I'm just not a Nobel Prize winning scientist. So I think the story is important. How did Joe, how did your advisor, if I'm your advisor, how did I come to this philosophy? Did I graduate University of Maryland on day one, start using the 4-factor model of investing and the work of Eugene Fama and Ken French from University of Chicago? No, I didn't. So I think this is good. This is a good story for you to hear because it really took me a long time, and I'm trying to help younger advisors maybe reduce that time frame. Compressed time is what I like to call it. So I graduated college in 1998 from the University of Maryland, and I had a communication degree. I had no background in finance at all. I didn't want to be in finance. I didn't think, it didn't occur to me as something I wanted to do. But as I was graduating from college, I didn't really have an idea as to what career I was going to do or what direction that was going to lead me. And I met somebody at an insurance company, a very large, well-known insurance company. And they said, look, we do these internships and I needed an internship. So I took it. And that was like my foot in the door of the financial industry, just, generally speaking. And this was 1998. And so what I was taught in this insurance company was that, they obviously taught insurance and they taught some planning. On the investing side, looking back on it, I don't think they did a very good job at all. But at the time, what they were teaching was active management. And they were saying things like, it's my job as the advisor at 23, with no background, by the way. It was my job to go out and pick which funds these clients should be in. And if the funds didn't do well, just move them to a different fund. And that's kind of, what we were being taught. The other thing we were being taught was that there was this concept or this phrase is that we were in a new economy. And you guys listening, you all remember, this was the .com era. And what I was being taught was that, well, the economy is different and this time is different and stocks just weren't going to go down anymore, not to any large degree because the internet was going to change everything. It was going to change the economy. It was going to change everything, the world. And they were right. Look, the internet obviously changed the world, but not in the ways that everyone thought it was going to, and certainly not in the individual companies that they thought were going to be the winners, and certainly not those funds that were very heavy in those individual companies. So what I saw was clients of this firm lose a lot of money because from 2000 to 2002, still young in my career, the NASDAQ, which was very heavy, it was all tech stocks back then, all internet, all .com, all tech stocks. The NASDAQ lost about 75% of its value. And it took 15 years, I think, to get back to even in the NASDAQ. And so I, as a young person, I'm looking at that. I'm like, man, that did not feel good. From 2000 to 2002, basically double digit negative returns all 3 years, essentially. And all of a sudden, nobody wanted to talk stock investing. Nobody wanted anything to do with it. And so I was obviously a little gun shy. I switched firms. I was at a new firm in 2000. This is in Washington, D.C., and they did a little better job. I thought they did a lot better job on the planning side, taxation and debt pay down and savings rates and insurance. And really, actually, that firm taught me a lot of what I use still today. Very, very solid. On the investing side, though, they really weren't. They were kind of like, oh, yeah, and then we invest money. There was no philosophy. It was kind of like, well, you could use this product or you could use that product. And they weren't really dictating who we used or why. And so then as I kind of got back into the investment world, it seemed very disjointed. And then 2008 hit and everyone lost everything again. It was, the S&P 500, I think was down, 38% or something like that. And I'm sitting here now. At that time, I'm 10 years into this business. And so I'm like early 30s. And I'm thinking, I'm never doing this again. I want nothing to do with investments. I don't want anything to do with it. It's a total casino. This makes no sense to me at all. Everyone's got great stories, but like the numbers never actually pan out. And that was 2008. I would say 09, maybe 2010. I had a colleague who said, you really need to treat investing not like a story, but that it's like math. Because that's what it is. And that caught my attention. So I decided I'm going to go find that, right? There's got to be something that would explain how portfolios should be built, not on gut instinct, not on speculating or gambling, but on math. Like, go figure. Now, it's probably going to be super boring, not very sexy, but if I was going to do investments for my clients as a certified financial planner, I didn't want it to be sexy and exciting. I wanted it to be based on something that was mathematically based, science, something I could tether to. So I went out and I found Eugene Fama and Ken French, their work from the University of Chicago, and Harry Markowitz and the Efficient Frontier. And by the way, a lot of these people who I stand on the shoulders of, these giants of our industry, I studied their work when I was taking the Series 7 and the Series 63 and all these different exams you have to pass. I studied their work, but it never dawned on me like you could apply that work to retail clients and investing. But you could, is what I found. And so I spent the next about 4 years, I'm just going to say, I'm going to round it, 2009 to 2012 or 13, just studying, just reading and studying, literally reading their books, reading their white papers. Like, what is factor investing? What does it mean? And it's not as complicated as you would make it out to be. If you're my client, you've heard it. A single factor I'll just say today, which everyone will say, well, yeah, that makes sense, is one factor is if you're looking for return, stocks tend to outperform bonds. I think everyone knows that. Well, that's a factor. That's a factor of investing. And Professor Fama and French took it, multiple steps beyond that. They said, well, there's also size, right? Size matters, and also book to value matters, and profitability matters. There's all these factors on investing, and they can distill it down to the math, and they can say whether or not a factor is random or whether there's actually something to it. In other words, if you look over long periods of time, 100 plus years, we know it's not random that stocks beat bonds. It's not random. It's not luck. There's actually a statistical analysis that can say the odds of that being just random or luck is significantly less than 1%. That's the work that they've done. And so I adopted that. And so I took that to my clients. And so really the last 15 years or so, I have never deviated from that. It's become my principles. It's become my philosophy. There's no need to deviate from it. It really helps me stand in the gap with you, my client, between really bad decisions or gut instinct or what you think might be happening or this time is different. I can stand in the gap between that and what the math says, which is really what you want. And the final thing I'll say is this. I really did learn this too. Just understanding the math is not enough. You really have to understand human beings. You have to understand behavior. And the best way I can describe this is that you, listening or watching, whether you're a client or you're a prospective client, you are emotional about your money because you're not a robot, okay? You are emotional. And guess what? I am emotional about my money. It's just a fact. And those emotions can damage and cause you to misbehave with your money no matter what the math says. The trick is I am not emotional about your money. You pay me not to be. I have zero emotion around it. I care about you, the client. And for that reason, I am going to be unemotional about it. And I'm just going to teach you and I'm going to educate you. And to the extent that you even care and want to know, that's great. Some of my clients love it and they go read up on this stuff too. And they kind of get into it. And others just say, you know what, that's for you to deal with and not me. No matter where you are on that spectrum though, I think it's important for you to just hear, like, there's been an evolution of this for me over the last 30 years. I wasn't lucky enough to come out of college as a 23-year-old, communication major into this industry and know exactly how to build a portfolio based off of statistical science. I didn't know. That took a long time. More importantly, once I found it, I never deviated from it. And I'll commit to you, I never will. This time is never different for me. It's all based on math. And then it's just my ability to explain it to you and get you to kind of understand it. You know, how do we measure risk is another way. That's a whole nother conversation. But how do we do that? How do we measure risk? What is risk? Again, that's not a feeling. That's a number. There's math behind that number. So that's been the evolution. I would expect, look, if I get to do this another 20 plus on years, I'm going to say the same stuff. AI is not going to make me change my opinion on math. Whatever comes after AI, the robots with AI in them isn't going to get my attention swayed any other way. Because I know two things will be true. One is math will be math. And two, humans will always have the behavioral, kind of direction that we have. And so again, it's my job is to navigate those two things with you, not to pick a better product, not to time markets or speculate or have some great sexy story. That's not what we're here to do. We are here to build a plan. And the point of the portfolio is to fully fund that plan. And that plan is going to hold all your hopes, dreams, desires, and legacies in it. And that's my job, is to make sure that that happens with you.
Joseph DeLisi is a registered representative and financial advisor of Park Avenue Securities, LLC, OSJ 5280 Carroll Canyon Road, 300 San Diego, California, 92121 619 648 6400. Securities products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. CA Insurance License number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Guardian and its subsidiaries do not issue or advise with regard to mortgages, property and casualty insurance, and or car insurance. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market interest rate, issuer credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index.
887225 4.1 expires 0528.